everyone, I'm Pooja Kamal. I'm your host for this beautiful 4thFEDAI annual day. और सबसे पहले आप सभी को virtual namaskar. How are you all doing? It is so overwhelming to see the wonderful response, people connecting with us from all parts of the globe, and so excited and so proud that each and every one that's present here today absolutely need no introduction and are all names in the world of finance. So, sabse pehle, please pat your back and please clap for yourselves for all the fabulous work that you've put out there. I am so excited to welcome you to a day that promises to be nothing short of exciting. How can it be anything short of it when some of the biggest is gorgeous virtual stage? I'm sure you guys just enjoyed the entire beautiful walkthrough and this whole grandeur of this lovely event that we're doing. And yes, on this very virtual stage, some of the biggest names, some of the dignitaries that we've been looking up to from years are going to come up and address us and give us some valuable insights. Now, for you to be able to enjoy this entire show to the fullest, I'm going to request you कि सबसे पहले तो please hold on to that phone or that laptop on which you're watching us. Back in the day जब phone गिरता था तो बैटरी निकलती थी, लेकिन अब अगर phone या laptop गिर जाए तो कलेजा निकलता है. So on a serious note, please look after this device. It's going to be very precious for us to be able to connect with you for the next couple of hours, and pray to the internet lords to support us with really good connection. But अगर आपकी connection थोड़ी हिल जाए, worry not, just log back in and please watch us on full screen mode. Probably rotate your screen if need be to be able to enjoy this virtual experience to the fullest. All right, once again, now let me officially welcome you to the 4thFEDAI annual day. I'm your host Pooja Kamal, and as we know, the FEDAI annual day, this is the fourth one, it keeps getting bigger and better every year, and we all are so proud to once again be connected on this beautiful form. FEDAI, as we know, is a self-regulating organization, and it has gone from strength to strength and continues to work with its partners to develop customized products and adhere to international accounting and risk management standards. Today, this beautiful annual day that we've put up is going to be divided into two segments. Both the segments are going to have some of the personalities come up on stage and have interactive sessions with us, and there are going to be some very interactive and informative panel discussions. And of course, like always, we are here to felicitate, award, reward, and recognize all the fabulous hard work that you actually put out there in the last year. Well, 2020 has been a very interesting year, to say the least. We've all learned to do different things, like this e-meeting that we're having. E-meet sunne mein kitna ajab gajab lagta hai, right? But this year's taught us a lot of things. I can see a lot of you smiling for all the household chores that it's taught us to do. But besides that, on a more serious note, who would have ever thought year 2020 through such huge challenges in front of us? But it's not the tough times that last, it's the tough people that do. And I think at FEDAI we have actually proved it. Year 2020 has been a big test, but as FEDAI passed this test with flying colors, didn't we? As financial market players, we faced all the challenges that year 2020 threw upon us, and we stood strong in the unfortunate turn of events. And most importantly, we came out on the other side with absolutely no dislocation. Such a sense of pride. This proves the resilience of our systems, our procedures, our technology, and we should really be proud of the way we've stood the test of time. On this note, I think it's now time to start this wonderful morning on an auspicious note. I'm going to say a few words from a Sanskrit shloka. Tamasoma jyotirgamaya, which means lead me from darkness to light, as our gurus always do. And to light up this morning, I'd like to call upon our esteemed dignitaries who always show us the right direction and always lead us from darkness to light. So first up, can we please have the one we're going to be most excited about receiving on this stage today, and later on, obviously, also hearing our chief guest, Shri Shakti Kanta Das, Honorable Governor, Reserve Bank of India. Y'all can really applaud, and even if the sounds of your clap don't reach us, the feeling, the energy definitely does. Our chief guest, like I said, Sri Shaktikanta Das, Honorable Governor, Reserve Bank of India. We are so excited. We also have our guest of honor, Sri Dinesh Kumar Khara, Chairman, State Bank of India. Shri B. Raghavendra Rao, Chairman, FEDAI and CGM Global Markets SBI. Shri Jujhar Singh, Vice Chairman, FEDAI. Shri Prasanna Balachandran, Additional Vice Chairman, FEDAI. Shri S. V. Sastry, Chairman, FIMDA, and also the Deputy Managing Director, Global Markets, State Bank of India. All these lovely dignitaries on this gorgeous to start this morning on an auspicious note of lighting the lamp. The very presence of all lovely dignitaries that we've started this morning with has already lit up our morning. I request all of you to please be seated, take your seats, and we will call you back on stage shortly. But for now, I request you all to please be seated. But I welcome Shri B. Raghavendra Rao, Chairman, FEDAI and Markets SBI on this gorgeous stage to set the tone for this wonderful morning. I request Shri B. Raghavendra Rao, sir, to please come and grace us with his presence. Good morning, sir. How are you? Sir, I think you are on mute. If you could please unmute yourself so we can hear you clearly.
Thank you. And I'm also, as you mentioned, very excited and keen to listen both Governor and our Chairman and other dignitaries and panels. So I'll start a little bit my opening remarks.
Yes, sir, the stage is set over to you, sir.
Yeah. Thank you. Chief Guest of the Day, respectable Honorable Governor Sri Shaktikanta Das, and Guest of Honor Sri Dinesh Kumar Khara, State Bank of India, Board of Directors and members of the Managing Committee, FEDAI, Madam Usha Thorat, Chairman, FIBIL, Mr. Shastri, Chairman, FIMDA, Mr. H.K. Jana, MD, CCIL, RBI officials, distinguished bankers and market participants, and FEDAI team led by CEO Mr. Ashwini Sindwani. A warm welcome to all of you. Today is a big day for FEDAI. This is our 4th annual day. I thank all the dignitaries for gracing this occasion. Before starting, I would like to dwell few activities of the FEDAI in front of our distinguished guests to know our activities. FEDAI as an industrial body in its 62nd year of existence is actively engaged with other industry bodies, regulatory authorities, government bodies on industry level issues to address problems, constraints and arrive solutions which are pro-market and also take care of interest of all market participants. FEDAI currently has 94 members. Its activities are guided and supervised by a management committee comprising of 24 member banks. FEDAI also has 2 standing committees, namely Technical Committee and Education Committee. FEDAI, along with IBA and FIMDA, is the joint promoter of FIBIL. As an interlocutor between market participants and Global FX Committee, FEDAI representing India FX Committee and is playing significant role in adoption of Global FX Code and best industry practices. In recent times, FEDAI's contribution to the drafting of Bilateral Netting of Qualified Financial Contract Act 2020 was deeply recognized and appreciated by the Ministry of Finance. FEDAI is in continuous dialogue with other local and global market bodies like FIMDA, CCIL, FIBIL, IBA, ICC, ISDA, and IFTA. FEDAI continues to contribute to training and capacity building in complex and rapidly evolving markets. With changing time, FEDAI has adopted new technology by switching into online training using e-books, online self-learning programs. Besides regularly organizing seminars, discussions on important topics, FEDAI since now over 2 years is issuing monthly newsletter running daily quizzes for frontline employees of the banks, help them to keep abreast with latest market developments and refresh their knowledge about regulatory guidelines and global market practices. I touch upon our development of forex markets in India. RBI has taken a number of steps to really take Indian forex markets to the next level, which I believe will result in better rates both large and small customers. For small customers, Reserve Bank of India and CCL have launched FX retail platform in August last year, which is a major step forward in providing transparent and fair prices to small customers. Several steps are also taken to attract forex volumes from offshore market back to onshore market. I think the panel will deliberate on this later. Earlier this year, RBI allowed banks to do forex transaction beyond the market hours, practically 24 by 7 market. Of course, COVID-19 halted this step temporarily, but I am sure once normalcy is restored, we will start this. RBI has allowed Indian banks to participate in rupee non-deliverable forward derivative market, addressing a long-standing concern of domestic Indian banks. RBI also eased a lot of restrictions on the type of derivative products that can be offered to customers of Indian forex market, which allows large corporates to efficiently target and hedge their risk. Also, recent draft guidelines issued by Reserve Bank of India on variation margin will help the domestic banks to post collateral in foreign currency with foreign counterparts, which gives them a significant business opportunity. Banks now increasingly using digitization to improve the customer experience. Indian banks are not too far behind their global counterparts in using latest technological innovations like blockchain, which will change the way business is done in trade finance and remittances. The reforms initiated over the last few months by Reserve Bank of India and the developments being undertaken by the banks are likely to herald a new era for Indian forex market. I believe that fair access to everyone has to be the pillar of any market development. And we all know, we all grappled with this pandemic. It has changed our lives and economies across globe. The governments have responded with lockdown measures and stimulus plans. Our own government of India brought a lot of packages like Atmanirbhar package, partial credit guarantee enhancement scheme, the changing definition of micro, small and medium sector. In normal circumstances, I believe, which will take months. But thanks to this COVID, we all acted swiftly and brought all the important acts in very swift manner. The central banks across the globe acted swiftly by cutting benchmark rates and started adopting even unconventional measures. In this front, the actions of RBI were lauded by many economists and regulators. We have taken so many important steps like LTRO, TLTRO, TLTRO2, handling the liquidity crisis of NBFCs, mutual funds, on top TLTRO, OMOs, Operation Twist. There are a few examples. I feel happy when I read 2 days back a news item that the RBI's Twitter has crossed 1 million mark, which is an important milestone and it is achieved by the first central bank in the globe, which which indicates the credence of our regulators. And the volatility and uncertainty will continue to persist till we get a clear vaccine to counter COVID-19. I believe that 2021 will be a complex year for foreign exchange markets, and I always believe this is a great opportunity. This type of opportunities don't come every day. We have to recognize and seize them with every chance we get. Wish you all good health, happiness, and success. Thank you.
Thank you so much, sir. I don't think there was any better way of starting this wonderful morning than that lovely address by you. And yes, everyone present here today is very proud of all the achievements of FEDAI, and we really hope that it keeps growing from strength to strength. Thank you so much, sir. With that is now time to call upon the one person, the personality that we all have been waiting for with bated breath. Let's not waste much time and let's quickly call upon our chief guest of this wonderful virtual event. Shri Shaktikanta Das, Governor, Reserve Bank of India. We are so excited to welcome Shri Shaktikanta Das and are absolutely humbled by his presence. We cannot wait to have him on this gorgeous virtual stage. Good morning, sir. How are you doing?
Yeah, good morning. Thank you. Thank you very much for having me here.
No, in fact, sir, it is an absolute honor to have you here because we all know that you're going to be giving us some very valuable insights. And for you, it isn't only about power, but it's always been about empowering others. So we can't wait to hear from you, sir.
Thank you very much. Very warm good morning to all of you. And namaskar once again. I'm extremely happy to be participating in the fourth annual day event of the FEDAI, and I'm extremely happy that we have the participation of Mr. Raghavendra Rao, the president, the chairman of FEDAI, and we have the other industry and the financial market associations here who are present here. I also note with a great pleasure the participation of Sri Dinesh Kumar Khara, the chairman SBI, and Srimati Usha Thorat, chairman FDIL and former deputy governor of Reserve Bank. We have the participation of various associations, their representatives, their office bearers like the FDIL, the FIMDA, the IBA, ICC. We have also the CCIL, 81 banks, my colleagues from Reserve Bank of India, and of course, last but most important, the other office bearers and the members of FEDAI. Now, our approach over the last 2 years or so been to increase the level of interaction with the market players, the financial market players, and with the other stakeholders in the market. I have always believed, and I have said it earlier also, that a consultative approach always adds depth to the quality of decision making. And I'm happy to say that over the last 2 years, and especially during the period of the pandemic, thanks to technology, we have been able to interact with leading market players, and that has definitely provided us very useful inputs, as a result of which we have been able to undertake a slew of measures to deal with this COVID-19 crisis. Many of the measures were proactively undertaken, many of the measures were reactive in nature, but our effort has been to always remain at the forefront to contain the impact of COVID-19 on the economy and on the financial markets. I wish to thank FEDAI for inviting me on this occasion. My best wishes and congratulations to FEDAI for completing 4 years, and I'm sure it will reach soon a silver jubilee and a golden jubilee, and perhaps move on to reach 100 years. So all my best wishes to FEDAI and its members. This is an opportune moment to look back and reflect on the developments of the last 1 year in financial markets, and in particular the foreign exchange markets. I have therefore decided to focus today on the theme accelerating financial market reforms in India. The year 2020 has been one like never before. Faced with an unknown crisis which brought the global economy to a sudden stop, recent policy discourse has been dominated, and rightly so, by the impact of the pandemic. Despite this, regulatory and institutional reforms in the country have moved the domestic financial markets to the next trajectory. Cutting across market segments, these reforms are ushering in a simplified, principle-based regulatory framework that seeks to broad-base markets by easing access, enhancing participation, facilitating innovation, protecting users, and promoting their conduct. Today, I would like to discuss imperatives and the building blocks of the recent reforms, placing them in the context of the big picture of a modern and efficient financial market equipped to support the aspirations of an open and integrated economy like India. Given that we are still amidst the pandemic where the near-term macro concerns dominate the discourse, let me start with a few words on the macroeconomic outlook and the financial market conditions. After witnessing a sharp contraction in GDP by 23.9% in the first quarter of the current financial year and a multi-speed normalization of activity in the second quarter, the Indian economy has exhibited stronger than expected pickup in momentum of recovery. The global economy has also witnessed a stronger than expected rebound in activity in the third quarter. IMF has accordingly revised its assessment for global growth in 2020 to a less severe contraction than what was originally assessed in June 2020. Even as growth outlook has improved, downside risks to growth continue due to the recent surge in infections in parts of Europe, other advanced economies, and also in parts of India. We need to be watchful about the sustainability of demand after the festivals and a possible reassessment of market expectations surrounding the vaccine. The monetary policy guidance in October emphasized the need to see through temporary inflation pressures and also maintain the accommodative stance at least during the current financial year and into the next financial year. A key source of wins in recent months has been the comfortable external balance position of India, supported by surplus current account balances over two consecutive quarters, resumption of portfolio capital inflows on the back of robust FDI inflows, and sustained buildup of foreign exchange reserves. The government's recent policy focus to enhance India's participation in global value chains, including through production-linked incentives for targeted sectors, can leverage on the strong external balance position of India. Financial market developments is an important thing that I would like to highlight next. Let me now turn to financial markets. The domestic financial market conditions were benign at the start of the year, but witnessed severe stress and dislocation as the COVID-19 pandemic unfolded. Thinning out of activity impacted market liquidity. Increased volatility of financial prices was observed across most asset classes. Yields hardened in the government securities market and the yield curve steepened sharply amidst concerns about fiscal slippage and sustained sell-off by FPIs. The financing conditions in the commercial paper and corporate bond market also deteriorated, reflecting overall market conditions as well as generalized risk aversion. The rupee sharply depreciated with increasing volatility and heightened forward premium. The Reserve Bank acted proactively and nimble-footedly to ease financial market conditions and mitigate risks with a slew of conventional and unconventional measures. Market participants responded with alacrity, and together we have been able to ensure stable and resilient markets across all segments. The Reserve Bank remains committed to fostering orderly functioning of financial markets as well as and will continue to evaluate incoming information having a bearing on the financial markets and will act as needed to mitigate any downside risks. Over the last 3 decades, the pace of financial market reforms has gathered momentum, albeit occasionally interrupted by financial crisis. A calibrated opening up of Indian economy has occurred since the 1990s. Alongside, the institutional architecture has been deepened, keeping in view the specifics of the country context. In the interregnum, the markets have also traversed a long distance. Over the years, the bond markets in the country have become broad-based in terms of participation, availability of a variety of instruments, and development of repo and derivative markets. The sovereign yield curve now spans up to 40 years and provides a stable pricing backbone for the development of the corporate bond market in India. The foreign exchange market has also come a long way with increasing diversity in instruments and participants and a growing integration of the economy with the global economy. Alongside these changes, significant improvements in market infrastructure have taken place, encompassing state-of-the-art primary issuances, uh, state-of-the-art primary issuance process for government securities, an efficient and completely dematerialized depository system within the central bank, electronic trading platforms, trade reporting, and central counterparty settlement. Even as the financial markets evolved, some imperfections became evident. Secondary market liquidity in government securities increased, but was confined to a few benchmark tenors. The participation base grew, but diversity of views remained limited, with predominance of buy and hold and long only investors. Interest rate derivative markets grew but remained limited to one product, that is, overnight indexed swap, and to a small set of participants. Domestic foreign exchange markets also grew, but so did offshore markets, fragmenting the global market for the Indian rupee and impairing market efficiency. New product development remained constrained, in part due to limited participation and also due to regulatory restrictions which had developed in response to the past experience with complex products and concerns about valuations and mis-selling. Meanwhile, episodes of misconduct and abuse in global markets raised the imperative of moving governance frameworks, of improving governance frameworks to preemptively safeguard domestic markets. But notwithstanding these imperfections, the resilience and strong foundation of financial markets nurtured over time also presented an opportunity. Markets with small number of participants, as all of you know, tend to become closed user clubs with predictable and behavioral attributes. Furthermore, speculative flows in thin markets, and this is something which all of you know quite well, speculative flows in thin markets can create distortions. In deep markets, these very flows can add liquidity and make the market more resilient. A calibrated opening up of the economy can supplement domestic savings and keep finance growth and help help finance our growth requirements and development. Against this backdrop, the Reserve Bank has taken several steps to usher in next phase of reforms to accelerate the pace of liberalization. The recent reform measures, many of which are in the works, have been fashioned around four major themes. One, liberalizing the financial markets and simplifying market regulation. Two, internationalizing financial markets. Three, safeguarding the buy side, that is focusing on user protection. And four, ensuring resilience and safety. Let me now discuss each of these themes. My effort would be to explain the rationale behind each of these measures which the Reserve Bank has taken, and also to place them in a broader context of our overall policy measures. These decisions should be seen in the context of a broader approach that we have with regard to market regulation and market development and maintaining financial stability of the system as well. First, let me focus on liberalizing financial markets and simplifying market regulations. The broad approach driving the recent regulatory initiatives is that any person with a need to access markets should be able to do so with ease at minimum cost. Principle-based regulations for interest rate derivatives and foreign exchange derivatives aim at achieving this broad objective. Detailed procedural prescriptions have been replaced with basic principles, thereby allowing greater operational flexibility for market participants. Earlier restrictions on design of derivative contracts and cancellation and rebooking of foreign exchange derivatives have been dispensed with. Distinctions based on residency have been removed or reduced, bringing foreign participants at par with domestic entities in terms of market entry and exit. While retaining the existence of underlying exposures as the basis for access, greater flexibility and ease of hedging have been brought in by allowing anticipated exposures to be hedged. Users with small and limited hedging requirements have been allowed to enter into contracts equivalent of US dollar 10 million without the need to establish the existence of underlying exposures. Simplifying regulations and providing procedural flexibilities have also contributed to easing operating conditions and thereby reducing costs and inefficiencies. While some operational constraints are inevitable, especially those warranted by prudential considerations, our approach has been to ease operating conditions within these broad considerations. Another example of this is the recent passing of the Bilateral Netting of Qualified Financial Contracts Act 2020, which addressed an important operating constraint. And in fact, this is something which the chairman of FEDAI also referred to. The absence of legal recognition of bilateral netting had discouraged the use of derivatives for effective risk management. The legislation provides the enabling framework for cash and derivative market transactions to be offset. This will enable optimization of capital requirement for financial institutions and will provide an impetus for development of the derivatives market in India. Let me now focus on the second theme of our second component of our broad approach, that is with regard to internationalization of the financial markets. Internationalization of financial markets can lower transaction costs with efficiency gains. Over the last 3 decades, India has undergone a transformation from being a virtually closed economy to one that is globally connected and open to a much larger volume of international transactions and capital flows than before. Today, the capital account is convertible to a great extent. Inward FDI is allowed in most sectors, and outbound FDI by Indian incorporated entities is allowed as a multiple of their net worth. The external commercial borrowing framework has also been significantly liberalized during 2019 to include more eligible borrowers, even as maturity requirements have been reduced and end-use restrictions have been relaxed. Foreign portfolio investment in Indian debt market has been expanded within calibrated macroprudential norms. Limits under the medium-term framework for investment by FPIs have been gradually increased and procedures have also been rationalized. A voluntary retention route (VRR) has been introduced, which provides relaxations from macroprudential controls but subject to a minimum retention period. In a major step towards greater internationalization, the fully accessible route (FAR) was introduced, under which non-residents can invest in specified government securities without any restriction. Capital account, and this is very important, capital account convertibility will continue to be approached as a process rather than as an event, taking cognizance of prevalent macroeconomic conditions. A long-term vision with short and medium-term goals is in fact the way ahead. As a major milestone towards opening up of markets, banks in India have been permitted to deal in offshore rupee derivatives markets. The measure is expected to reduce the segmentation between onshore and offshore markets, apart from reducing volatility and cost of hedging. Banks have also been permitted to undertake foreign exchange transactions beyond the usual onshore market hours, thus fostering real-time market activity. In a complementary measure, exchanges and banking units in the GIFT City have been permitted to undertake over-the-counter, that is OTC, and exchange-traded rupee derivatives. The third aspect I would like to highlight, as I had mentioned, is with regard to the safeguarding the buy side, that is user protection. Safeguarding the interests of the users, that is the buy side of financial markets, is an imperative, especially in the context of liberalized markets and introduction of newer and more sophisticated products. A number of initiatives have been taken in this regard, a few of which I would like to mention. With a view to providing greater protection to less sophisticated users, a user classification framework segregating users into retail and non-retail has been introduced for OTC foreign exchange and interest rate derivative transactions. Retail users can be offered only non-complex derivative products, while product innovation has been permitted for non-retail users as per their business needs. The issue of fair and transparent pricing of foreign exchange products, especially for MSMEs and other small users, has been occupying our attention. Market makers are now mandated to separately disclose fees or charges when dealing with retail users. Also, an anonymous order matching electronic platform called FX Retail has been launched by the Clearing Corporation of India, CCIL, at the behest of the RBI. This platform allows users with small transaction sizes to undertake transactions at best available market rates. These measures are expected to ensure greater transparency and protection of retail user. Concerted efforts by banks will be required if the benefits of transparent and competitive pricing are to reach every user of foreign exchange markets. A derivative markets As derivative markets are liberalized, market conduct needs to be strengthened through robust assessment of product suitability and user appropriateness. Regulatory requirements in this regard are being reviewed in consonance with the overall changes to the regulatory approach. And this is something which is in very advanced stage, and we should be able to finalize it quickly. Let me now finally turn to the focus on the fourth area of our approach, that is ensuring resilience and safety, after which I would conclude. Financial market infrastructure in India has remained resilient even during various financial crises. Learning from international episodes of market failure, several further initiatives have been taken to ensure continued resilience. Fair market conduct is critical to ensure efficient functioning and preserving trust in the financial ecosystem. Hitherto, conduct codes prescribed by market bodies like FIMDA and FEDAI FIMDA and FEDAI guided market participants in financial markets. To supplement and strengthen these, please note, to supplement and strengthen these, a regulatory framework for market abuse has been put in place. The idea is not to replace or not to replace what FEDAI and FIMDA have done, which is seen to be very useful. That is our experience. But the idea is to supplement what FEDAI and FIMDA have done. We have put this regulatory framework for market abuse in place. The Reserve Bank has been taking measures to implement the G20 over-the-counter derivatives market reforms. In line with global trends, electronic trading platforms have been brought under regulatory purview to ensure efficiency of operations and address systemic risks. A draft framework for variation margin for OTC derivatives aimed at reducing counterparty risks from non-centrally cleared derivatives has also been recently issued, and this was referred to by the chairman of FEDAI, and we will be carrying further. This is work in progress, and once the comments etc. are received from all of you and from other stakeholders, the RBI will issue the necessary guidelines. Global efforts are underway to put in place a legal entity identifier, that is LEI, which uniquely identifies financial market participants' aggregation of risks. Reserve Bank has also mandated the use of LEI for participants in markets it regulates. In fact, we are one of the few countries that has implemented the LEI beyond derivatives market to cover transactions in government securities and money markets, as well as the credit market, that is especially with regard to the large loans. A key issue which has been engaging global attention is the transition from the LIBOR to alternate reference rates. In India, several measures have been taken to make financial benchmark procedures more transparent and robust. More recently, the administrators of significant financial benchmarks were brought under regulation to ensure robust governance frameworks and process controls. These reforms will stand us in good state as we prepare ourselves for the LIBOR transition. The Indian Banks Association has been working closely with the market participants to facilitate the transition to alternate benchmarks and create customer awareness. Achieving a smooth transition from a benchmark entrenched in the financial system will require significant efforts from all stakeholders. And this is one area, I think, where associations like the FEDAI and others have an important role. The FPIL also has to play an important role. And I'm happy to say that officials and our teams are constantly engaging with you. And I think this vibrant and this interaction, this process of interaction will definitely make the process of transition very smooth. Let me now just conclude all that I have said. I have attempted today to set out the broad themes which have guided the liberalization and reform agenda for financial markets. The recent changes are aimed at enabling financial markets to enhance allocational efficiency in the use of resources and thereby contribute to economic development. With this freedom comes responsibility. This is very important again for all market players, for all market participants. The achievement of the desired outcome is, however, contingent on financial institutions and market participants taking forward the reform agenda so that we have vibrant financial markets and efficient financial intermediation. The simplification and flexibility provided in the regulation must reach the end user. In designing new products and new market segments, risk management systems and responsible market conduct should evolve in tandem as we open up to global players. Market participants and their associations, including FEDAI, will have to play a critical role in this. I will stop here. Thank you very much for your patience.
Thank you so much, sir, not just for your presence, which means the world to us, but for actually explaining everything so meticulously to the T. I'd like to now request once again our chairman, Mr. Raghavendra Rao, to please come on this virtual stage again.
Honorable Governor, thank you very much, sir. From FEDAI side, we profusely thank you for your presence and your valuable inputs and the direction. From the FEDAI side, we will assure you, sir, we will continue to take the initiatives of Reserve Bank of India and we will mediate between the markets and Reserve Bank of India. Once again, thank you, sir, for your gracious presence. We really appreciate and be thankful to your presence, sir. Thank you, sir.
Thank you. It was my pleasure to be here, and I wish we will have opportunity of meeting, in a physical conference sooner than later. My best wishes to you on the occasion of the 4th annual day. My best wishes to all the other market players and their associations, the other stakeholders here who are present today. I think you have an excellent agenda ahead of you today, and thank you very much for having me here.
Thank you, sir. Thank you very much.
Thank you once again, Shaktikanta sir. Thank you so much, Mr. Rao. It's been an absolutely amazing start to a very lovely day ahead. And with that, ladies and gentlemen, we have now come to the second segment of this wonderful annual day. And just like we started in style, our first segment, we're going to start on a very high note, our second segment as well. We're going to call someone who, once again, we're very, very excited to not just see on this virtual stage, but also to hear his valuable inputs. So with a huge round of applause, which trust me, the vibrations do reach us, let's welcome our guest of honor, Shri Dinesh Kumar Khara, Chairman, State Bank of India. We are so delighted to have you here. Shri Dinesh Kumar Khara, sir, Chairman, State Bank of India, guest of honor. Good afternoon, seeing you here.
Very good afternoon to all of you, all the participants who are here today. Respected Honorable RBI Governor, Shri Shaktikanta Das, Chairman of FEDAI, Board of Directors and members of Managing Committee of FEDAI, other distinguished bankers and other market participants, a very warm welcome to all of you. I wish to thank FEDAI for inviting me today at the 4th FEDAI Annual Day. Markets across the globe have witnessed and continue to witness a good deal of volatility ever since the onset of COVID-19. I would therefore like to dwell upon the volatility in the market across the globe with a focus towards handling currency volatility in the current global macroeconomic situations. Every 3 months, IMF comes out with a widely popular publication called the World Economic Outlook. While the projections in each of these reports make headlines, every time there is a major revision. These reports also have an interesting title, which in a way summarizes the sentiments of not just the report, but also the economic situations of the time. I want to start by reading out of the titles of the last 3 reports. The Great Lockdown in April, A Crisis Like No Other, An Uncertain Recovery in June, and the latest, A Long and Difficult Ascent in October. These titles defines the global macroeconomic situation during the last 9 months or so. And while neither mention it specifically, the common thread in these titles and the global economic situation over this period has been the COVID-19 pandemic. For the last 9 odd months, COVID-19 has been the biggest event in not just our personal and professional lives, but also in the global financial markets. The most destructive pandemic since the century-old Spanish flu, COVID-19 has devastated economies and has truly been a crisis like no other. At least in our lifetimes, once the pandemic started to spread, government across deployed what is probably the most widely used tactics in case of epidemic, that is isolation. Large parts of the economies were shut to ensure that those already infected do not infect others. Financial market reacted sharply to these lockdowns, with CBOE volatility index increasing from around 14 levels to a high level of 82.69. Commodities, especially crude, collapsed, with the Brent trading at sub USA 20 per barrel level briefly in April. Even now, crude prices are down around 35% from the levels seen earlier in the year. Forex market volatility has also spiked, and while it has come down as fiscal and monetary measures convinced markets against betting on a total meltdown. Central banks from the emerging markets also followed major central banks by cutting rates and adopting non-conventional policies. Other than COVID-19 related disruptions, we have seen sharp depreciation in some of the emerging market currencies like Turkish lira and Argentinian peso this year. These are mostly due to longer lasting issues in these economies. Geopolitical tensions such as Indo-China border skirmish, US-China trade tensions, etc. also weigh on the regional or broader risk sentiments. Indian rupee has been a surprise beneficiary of COVID-19 spread, especially after the initial depreciation witnessed in March 2020, mainly as central bank pumped liquidity into the markets, which started chasing returns. We have also seen record inflows on account of FDI and FPI inflows this year, especially in equity market, which bounced back swiftly post the sharp decline seen in March. RBI is still now ensured that rupee does not appreciate significantly against its export competitors due to these capital flows. The same is reflected in the country's forex reserves, touching an all-time high of USD 572 billion and increasing by about 111 billion in this financial year itself. Exchange rate fluctuations can increase the cost of doing business internationally. In addition, forex rates can make it difficult to make accurate business decisions by adding another layer of uncertainty. Finally, large forex moves can make certain businesses or investments unviable, making it necessary to have some kind of a stop loss. One common feature that has been witnessed is that many central banks have concern or are very vocal about currency appreciation or depreciation. The initial volatility in the forex market was a reaction to the disruptions caused in not just the workplaces or the dealing rooms across the world, but also as forex transaction volumes dipped sharply. Due to the lockdown and travel restrictions, global supply chains were disrupted, leading to a sharp decline in the global trade volumes. As per WTO, April-June quarter saw a 14% quarter-on-quarter decline in world merchandise, the largest on record, perhaps. For 2020 as a whole, WTO expect about 9% decline in the world merchandise trade volumes. Lower trade-related forex volumes could be one of the reasons for higher volatility being seen in the forex market. Overall impact on forex volume has probably been less, mainly due to portfolio or investment flows. In March, we saw massive outflows from emerging markets, with Institute of International Finance estimating the outflow in the range of about 103 billion from emerging markets between mid of January to mid of May. These outflows have subsequently been replaced by strong inflows into emerging markets equities in the subsequent months, mainly due to easy liquidity and relatively attractive valuations after the crash in March 20. But these flows have added to the volatility in the forex market, especially for emerging market currencies. While the March sell-off saw sharp depreciation for emerging currencies, including rupee, the trend has since reversed with massive inflows leading to appreciation of the currency. Reserve Bank of India has played an important role during this period through significant efforts to contain volatility. Otherwise, we would have seen much larger moves in the Indian forex market. Lower forex volumes are contributing to the heightened volatility in the market, but the underlying reason remains the uncertainty associated with the current economic scenario. Going back to IMF's October World Economic Outlook, which states that the uncertainty surrounding the forecast is usually large, as it depends on public health and economic factors that are inherently difficult to predict. The spread of COVID-19 has been extremely difficult to predict. Markets also had to contend with the difficult questions of whether the economic impact of the spread of COVID-19 will be greater or that of the lockdown imposed to contain the spread. Each country is struggling to find a balance between the two, and even after so many months and so many different methods employed by different countries, there appears to be no clear-cut answer as to what would work best. This kind of uncertainty has perplexed even the most accomplished economist, as is evident from the variation in various growth forecasts through the last 9 months. Forecast has become more perplexed, like the famous quote, "When the fact changes, I change my mind." Forecasts for the current quarter are still being changed as many countries are experiencing another wave of infection. This kind of uncertainty is likely to continue to persist till we are able to vaccinate a large part of the population. The timelines for when that may happen also remains highly uncertain. We saw very recently the reaction of financial market to the news of vaccine showing promising results. There was an immediate euphoria followed by a sell-off. We also have Brexit and EU and the UK having to decide upon all the rules of separation by the end of December this year. Already, they may not be left with enough time for implementation, and the same could lead to increased volatility in both the British pound and euro. This could have spillover effect on other currency pairs. When so much depends on such uncertain outcomes, one thing that we can be certain about is volatility. Of course, for rupee traders, the quantum of volatility would be much higher or lower depending on inflows or outflows, and therefore it would be prudent to stay prepared. The outlook for economic growth is likely to become a key factor. At the global level, this will hinge on the battle between the grip of COVID-19 and the vaccine. At the local level, in many instances, it will hinge on the scope for the policy to help underpin activity. Geopolitical uncertainty may also be reduced with the US elections, but will largely depend upon the policy of the new US government. I still believe that 2021 will be a complex year for Forex and not a simple case of broad USD strength or weakness. This brings us to the question, how do we handle this currency volatility in such uncertain times? The answer would depend upon what role you play in the Forex market. If you are a market maker, you would tend to give wider quotes when market gets volatile. Most traders would actually be happy at the return of volatility after nearly 5 years, as it gives them an opportunity to make money. Sudden moves could hit them hard, especially if they are on the wrong side, and all their positions could go out of money in an instant, with no recourse except to cut losses, which could be significant for large market makers. On the other side, market takers, especially businesses with currency exchange rate exposures, need to protect themselves against adverse movement. Some corporates have natural hedge available in their business models, which can be used to safeguard against Forex volatility, at least partially. For others, depending on the size of the Forex exposure relative to the size of revenue, different hedging levels and strategies can be explored. As a first step, each business that has an exposure to exchange rate need to review its full operating cycle and determine profit margins. Based on this, a Forex policy needs to be put in place, if not already in place, which defines the risk tolerance in absolute term, as well as the steps the business needs to take to manage the risk from currency exposures within the risk tolerance at all the times. Once this is done, India has a well-developed Forex derivative markets that can be utilized to manage Forex volatility. For small treasuries, simple forward contracts are often the best solutions, as they are easy to understand and are linear products, whereas the final rate can be determined beforehand. This can be especially handy as it removes that extra layer of uncertainty in the business planning. The company's management can calculate the exact margin it would take and predict actual cash flows. For larger treasuries, plain vanilla options and combinations thereof could provide good, low-cost hedging options. Here you can control the worst-case scenario, which means you can price your product and finalize your margins at the same time, allowing for many upside to be available. For large, sophisticated treasuries, Indian banks offer the whole gamut of derivative products, and based on their internal views, they can choose to target specific risk at specific times. For example, since the headline for Brexit negotiation is known, a business with exposure to GBP could decide to hedge themselves against large moves in GBP INR pair. At the same time, while hedging against specific risk may be more cost effective, the Forex hedging policy should also consider possible large unforeseen Forex moves. Finally, one of the lessons of the 2008 crisis was to never bet against something happening just because that has not happened in the past. So I think when we look back, we also observe that US Fed and major other central banks have expanded their balance sheets significantly since the start of this year and have plans to continue over the next year and beyond. For some context of size of asset purchases, it's interesting to compare it with the post-2008 asset buying. US Fed had increased their balance sheet size from 1 trillion in 2008 to a peak of around 4.5 trillion by late 2014. That is by 3.5 trillion over a period of 6 years. This year, since March, Fed has increased its asset holding from 4.1 trillion to 7.1 trillion, an increase of 3 trillion in less than 9 months. ECB is also delivering a more aggressive expansion of its balance sheet. Likewise, Bank of Japan also have pumped in around about 21 trillion so far. Looking into next year, a case can be made that powerful push factor will derive robust capital flows into emerging market assets. Additional fiscal stimulus being deployed in the major advanced economies and success of the vaccine front that eases fears of the pandemic would result in the global hunt for yield returns and a vengeance too. We expect other developed central banks to follow suit, keeping rates near zero or negative for longer into the recovery phase, which will act as a major amplifier, pushing a rising share of financial wealth in the world's richest countries to emerging markets. Meanwhile, many emerging markets may also want to sharpen their currency appreciation and instead prefer to build up the forex reserves. Given the unprecedented portfolio capital flight in March, this level of asset buying in such a short time is likely to have consequences for the financial markets across the world. There is a real risk that once COVID-19 is tamed, markets may start pricing in a reversal of this exceptional asset buying. Examples such as South Korea problem with sudden capital outflows, notably in 2008, are recounted. Indonesia has regular surges and retreats of foreign funds, which results in volatility, while India to witness capital outflows pressure at regular intervals. We cannot time exactly when these flows will turn, leading to massive spikes in the volatility. It could happen next week or maybe next year. There is a reason to believe that an effective vaccine may be available to general public in India by April 21. The only prudent thing to do for the businesses is to ensure that they are prepared to handle the volatility. Finally, let's hope the April 21 World Economic Outlook is titled The End of COVID. I would like to end my address with one remark. The future is uncertain, but this also leaves us with immense opportunities. So with these words, my best wishes to FEDAI and all the participants of FEDAI to navigate the uncertainty in the year ahead with whole lot of professionalism, with a lot of prudence. Thank you very much. Stay safe, stay healthy. Bye-bye.
So beautifully put, sir. Like you said, the only thing consistent is volatility, and we are expecting a complex 2021. But your valuable inputs are going to go a long way in getting us future ready. Thank you. And once again, I'd like to request Mr. Rao, our chairman, to come back on the stage, please.
Respected Chairman State Bank of India, sir, thank you very much for sparing your valuable time giving this address. From FEDAI side, we profusely thank you, sir, for your inputs. Thank you, sir, once again.
Thank you. Thank you. Thank you very much. All the very best to FEDAI's annual day celebration.
Thank you, sir.
Thank you, Dinesh Kumar Khara, sir, and thank you, Mr. Rao. With that, it's now time for us to enter our segment for awards, felicitations, rewards, and basically recognizing all the wonderful hard work that so many of our shining stars have put out there. You know, they say success isn't about greatness, it's about consistency. Consistent hard work leads to success, and of course, greatness will follow, it will come. It's now time to recognize, felicitate all those that have worked hard relentlessly. And we're going to begin with our first felicitation, which is for the hard work of our key contributors. As we all know, FEDAI plays a very important role by providing reading material, such as e-books and physical books for knowledge upgradation and capacity building to keep pace with the changing time. It is in this area that we cannot help but thank some of our shining stars for their valuable contribution. Let's have a look at who these shining stars are. First up, Mr. Sudhiranjan Sahu. Bank of Baroda, thank you for all that hard work that you put out there relentlessly. And Mr. Prem Ranjan, HDFC Bank Limited, another shining star of ours. We also have Mr. Chinmay Gopal, Punjab National Bank, kept that night oil burning and has worked hard without looking at day or night. And last but not the least in this category, Mr. John Basil, Axis Bank Limited. Thank you once again for all the wonderful work that you put out there. It means a lot to FEDAI. Let's now go to our next category, and in this we are going to congratulate the winners who with their hard work acquired a commendable amount of knowledge. This knowledge acquisition and their hard work has reflected in their top scores as they topped the FEDAI certificate course in foreign exchange operations examinations. Let's take a look at who they are. Our proud winners, Mr. Madhur Agarwal, JP Morgan Chase Bank, NA Mumbai in the examination held in April 2018. Mr. Swatantar Kumar, Union Bank of India, October 2018 exam. We also have up next another very, very hard worker, Mr. Vittal Rao Bogeli, IDBI Bank Limited, who has topped the January 2019 exam. And so many more achievers that we cannot help but congratulate on this platform. Mr. Chanchal Mishra, State Bank of India in the 2019 special exam. Who do we have up next? Congratulations all our winners. Mr. Pavan Goyal, UCO Bank, April 2019. Congratulations. This really is your moment of glory. Mr. Rajneesh Kumar, Shinhan Bank, July 19. In the July 19 exam from Shinhan Bank. We have Mr. Rakesh Kutala Muralidharan, Deutsche Bank. Congratulations. January 2020 exam, you totally aced it, sir. And we also have coming up next, Mr. Priyabrata Mishra, State India, in the 2020 special exam. You completely shined. With that, it's now time for our next category, which is last but not the least, the time to bring to the limelight those who have always been a step ahead. In fact, they've been future ready. They can foresee the times ahead, and their predictions in the FEDAI survey 2018-2019 closest to reality. We first have a second runner-up that we're going to be announcing. Congratulations, Mr. Pradeep Pathak from Canara Bank. You are the second runner-up of the FEDAI survey 2018-2019. Let's look at our first runner-up now, who predicted the future very, very close to what the reality turned out. And our first runner-up is Mr. Dinkar Sanpal, Bank of Maharashtra. Congratulations for your fabulous work. I can actually imagine you smiling beautifully right now. And last but not the least, we have a clear winner that has actually predicted the future very, very close to reality. Miss Kinjal Shiani, Bank of Maharashtra. Congratulations to the gorgeous lady, and more power to Nari Shakti. It gives me great pride in announcing Miss Kinjal Shiani as the winner of the FEDAI survey 2018-2019. That's some fabulous work over there, and they are really our shining stars. And once again, congratulations to all the winners. With this, I'm now proud to once again make another very, very important, not just announcement, but to actually share with you all another landmark for us at FEDAI. And I want to tell you all about FEDAN. Now, what exactly is FEDAN? FEDAN is an association of banks in Nepal. As you all know, FEDAI has spread its wings not just in India, also forming collaborative arrangements with our neighbors. And FEDAN is one such arrangement, which I'm so excited to tell you about. FEDAN, as I just said, is an association of banks in Nepal. And with the approval of FEDAI Managing Committee, we have entered into an MOU with FEDAN. Such a proud moment for us. Now, what exactly is the work that we're going to be doing? It is basically a mutually beneficial strategic alliance and evolve and formalize a process of understanding and cooperation for development of knowledge sharing, training, and research, which is basically going to include sharing of knowledge through participation at conferences, seminars. There are going to be workshop studies, group discussions, and also a lot of research and development, which is going to happen on mutually agreed terms and conditions. So here, there's another feather to our cap, the FEDAN, which I'm happy to share with you all. It's now time to call upon someone who we're going to be very excited to see up here on this stage. Why is that? Let me tell you a little about his body of work, and that itself will be self-explanatory. Yes, that's right. Shri H.K. Jaina is the Managing Director of Clearing Corporation of India Limited, and he's also the Deputy Managing Director, Global Markets, State Bank of India. He's been working with SBI for over 30 years in India and abroad, and has held very important positions across various departments of the bank. And we're so excited to have him here today because in his capacity as DMD SBI, he was also the chairman of FEDAI since 2017 to 2020. Let's call with a huge round of applause Shri H.K. Jaina sir on this virtual platform. Good afternoon, sir. How are you? I hope you've enjoyed the show this far.
Yeah, good afternoon. It was all good. Thank you.
We can't wait to hear from you, sir. The stage is set. Over to you.
Can you could you hear me?
Yes, sir. Your voice is absolutely loud and clear.
Okay. Thank you.
Thank you.
Respected Chief Guest, Governor, Reserve Bank of India, Mr. Shaktikant Das. Respected Guest of Honor, SBI Chairman, Mr. Dinesh Khara. Chairman FEDAI, Mr. Raghavendra Rao. Chairman People, Madam Usha Thorat, ex-DG of RBI, and she also happened to be our chairman earlier, so ex-chairman of CCIL board. Chairman FIMDA, Mr. S.V. Sastry. Vice Chairman FEDAI and FIMDA, Mr. Prasanna. Other dignitaries from Reserve Bank of India, other banks, financial and non-financial world. It gives me immense pleasure to be associated with this occasion. This is the 4th annual day celebration of FEDAI, although FEDAI has been in existence for quite long. But to be very honest, this is the first annual day. All others were annual evenings only. So probably the COVID had literally made it as annual day. So during the broad daylight, we are celebrating annual day. Since in 2019, we couldn't have one. So at least I'm very delighted that it could happen in 2020, and that too in the august presence of our Governor, Reserve Bank of India, and Chairman, State Bank of India. So I profusely thank FEDAI management, Chairman, CEO, and others to give me this opportunity. So currently I have joined as MD of CCIL. So my ex-employer is State Bank of India. So I left SBI in 2020 May. So I joined here on 1st June. I will just, since I have any format to speak on, I will very quickly just say something on CCIL and then I will end up. So as per the governor's speech, I think accelerating the financial sector growth, liberalizing the financial sector, internationalization, global connectedness, resilience, and safety, they were of paramount importance. And Chairman SBI also points on volatility, could be currency, could be commodity, could be rates. So when you go for further liberalization or internationalization, that in fact is a sign that we are growing and we are trying to have a better and more resilient market. But whenever we liberalize, like in the student days we used to hear, that we have to grant liberty, and ours is a democratic polity, so liberty is extremely important, both individual and organizational. So whenever liberty is provided, so there would be attendant risks as well. So whatever we have read during the student days, that eternal vigilance is the price of liberty. So we have to always be vigilant. How do we remain vigilant? That is basically identifying the risk factors. After identification, then we will have to manage it through either various risk control measures or diversifying the risk so that the risk doesn't hit somewhere or we are not caught on our. So all those risk factors, if we feel that we have to reduce, then probably we need setups, organizations which could reduce the risk. Clearing Corporation of India Limited is one such institution. It's a wonderful institution. And maybe RBI had thought ahead of time and could set up such, at least accelerate setting up such an institution. So the relationship with RBI is that RBI is the regulator, but most of the thought process, even product, conceiving the ideas to set up products and all those things, would be coming from Reserve Bank of India and other market participants, including Clearing Corporation of India. So our CCIL it's a public utility provider. So, and we are user owned. It's unlike any commercial entity which would be also providing public utility. So we are owned by the members. Only the users can own shares in CCIL. So that way, I think the governance point of view, so certainly we feel that the corporate governance standard would be a lot better. We'll do the things which the financial market needs. We will not do anything like any commercial entity. They not only cater to the needs of various say consumers or the end users, they create needs in the users. So whenever any entity creates needs in others for its commercial, propose a commercial value, so there is a possibility that the risk component could be high. But although we do not believe in that, but we try to early identify the needs of the members or other users. So far as our structure is concerned, we have our members, that is mostly banks, some financial institutions, primary dealers, mutual funds like, and we cannot have only a class type of thing that where the settlement and clearing progresses. So facilities are also given to clearing members. So clearing members means the clearing members would be the banks and the clients can join through them. They will have access to the market and they can do the things. So we have clearing member structure in almost all the segments. Again, when I speak about the structure of clearing corporation, although it is everything is known to be a function of CCIL, but CCIL family I will include, there are two wholly owned subsidiaries. One is the ClearCup Dealing Systems Limited. The other one is the Legal Entity Identifier Limited. So the ClearCup Dealing System Limited, that ClearCup, that owns all the trading platforms. All the electronic trading platforms are owned by it, except NDSOM, which is owned by Reserve Bank of India, and we manage it. CCIL manages it. All other ETPs are owned by ClearCup, and we have a Chinese wall between ClearCup and so far as the clearing corporation other activities are concerned. There are identified set of people who undertake these works, and the accounts are maintained separately. The board is also the board at least have different other members other than the managing director. And the LEI is again a separate company. So on these two counts, I have like we have been hearing a lot of things, the homegrown thing, Atmanirbhar Bharat. So I will call upon all the dignitaries to join in popularizing the ETPs owned by ClearCup Dealing Systems Limited. We have some of the on the government security side, they are used very well by most of the members and some clearing members. And so far as the forex side is concerned, probably we have to go a little longer. And since these are homegrown platforms, and I assure that whenever there is any issue that we need to develop, if there is any deficiency, then certainly we will try to recoup all those things, and we will make it one of the internationally competitive platforms available in the market. I will not say that at an inefficient execution also people should come and use it. We'll say that we will provide one of the most efficient and effective platforms. If you have or the members they have an issue, that we will provide. But I request all the members that they can more and progressively use more number of times or for more number of deals FX Clear platform. When we had given it to the retail segment, the FX Clear retail, I think the chairman FEDAI and the governor also have spoken. So FX retail also can be used by the members. So far as LEI is concerned, I have only one request, that since again this is a homegrown, we are the only LOU identify the glyph recognized by the glyph. So I thank especially the large banks, and I hope if the chairman State Bank of India is there, so I request that at least it can take place through us. Although the LEI was taken before the existence of LEIL in Clearing Corporation family, so I request that all those large banks have issuances beforehand and they have taken LEI from elsewhere, the renewal can be done through us. So far as the clearing settlement is concerned, we are there to reduce the risk. The netting component is very high. So in some cases it would be as high as 95%, although gross turnover would be very high. But once it achieves a netting percentage of 95%, so naturally the net settlement amount would be very small. And the governance standard being very high, and most of the profits is retained in the company, so that we can provide a lot of comfort to the members, to the outside world, that we are systemically important and we are very strong as well. So for that reason it is retained, and our settlement guarantee fund and default funds are percentage wise much more significant compared to many of the competitors. So it's a strong company, it's your company, and it helps us, all of us, in the goal of at least achieving Atmanirbhar Bharat. So I request all of you, I thank FEDAI management for giving me this opportunity. I wish them all success in the celebration. Thank you.
Thank you so much, Jenna sir. I think I love the way you put that it is actually for the first time an annual day. It's generally evening and we're doing broad daylight. But unfortunately, apne gharon mein, offices mein band, we can't even enjoy the daylight. But I think you really added the light to this wonderful morning. Thank you. Thank you once again, sir.
Thank you.
And ladies and gentlemen, thank you for actually being with us all through this wonderful morning. But trust me, it gets more and more exciting. In fact, now I'm going to introduce a very exciting part of this morning, which is actually now gone into the afternoon, a very interactive panel discussion. And very soon we're going to be calling our esteemed panelists. Let me quickly tell you the topic of the panel discussion, so you can already put your thinking caps on. The topic is market reforms leading to deeper domestic markets, precursor to CAC, Well, that is going to be a very interesting discussion. So you all can start thinking. I've given you all food for thought. But before that, before we call our esteemed panelists, for some pre-panel comments, we will be calling someone whose introduction again is absolutely endless. In fact, she needs no introduction. We've already spoken about her in this event a couple of times. Almost all our wonderful dignitaries that came here have said, and I'm sure there is a lot of excitement once again to see her on this beautiful virtual screen. So with bated breath, we're proud to welcome Srimati Usha Thorat, Chairperson, Financial Benchmarks, India Private Limited, and also former Deputy Governor, RBI. In a quick nutshell, before we call her on this lovely screen, I'm going to tell you a little about her career in RBI. At all areas of central banking, she's been instrumental in making reforms in the government securities market and debt management by RBI, including setting up of the ND and the CCIL, with which Mrs. Thorat was closely involved. After stepping down from RBI also, she became the first director of the Center for Advanced Financial Research, and post her retirement from RBI, she has served on and chaired many important committees appointed by the RBI. Such an honor, Srimati Usha Thoratji, to have you here. Can we please have you on this beautiful stage? Good afternoon, ma'am. How are you? Looking absolutely gorgeous.
Thank you. Thank you so much for your very warm introduction, and welcome. Thank you.
Thank you. In fact, I think we cannot think of a better person for the pre-panel comments, especially since you are the one that has chaired the task force on offshore rupee markets set up by RBI. So the stage is set. Over to you, ma'am.
Thank you so much. Thank you very much. Indeed, I am extremely grateful to the FEDAI organizers for inviting me for this event. I really felt very honored and humbled when the governor actually invited me by name, and all the other dignitaries who have spoken so far. It's really a feeling of what shall I say, tremendous humility to be remembered so warmly. So thank you very, very much indeed. And it's a very good opportunity for me, and I really am addressing my comments to all the participants in the foreign exchange markets and the fixed income markets. And I think there is a huge opportunity that we have here before us that that I truly think that we need to take full advantage of. So, and my comments are just some thoughts that I had prior to the panel discussion, to which I'm really looking forward. So, deeper and more liquid financial markets lead to efficient allocation of financial resources. And so they are a integral part of the institutional fact of modern economies based on the principles of market economy. The development of financial markets, and Governor so eloquently, outlined it, has been part of the agenda for India since the early 90s, when the reform process started. Safe and efficient markets need market microstructures that ensure transparency, fair and competitive access, safe and efficient trading and settlement systems, risk management systems, mechanisms such as mechanisms to prevent excesses, mitigate clearing and settlement risk, and so on. Deeper and more liquid markets need end users, arbitrageurs, market makers, and speculators. When markets are driven by excessive speculation beyond what the fundamentals imply, there can be excessive instability. So market failures can also arise due to other factors, such as asymmetric and insufficient information, lack of understanding of the risks of products, moral hazard leading to excessive risk-taking, lack of competition and market rigging, excessive leverage, and interconnectedness. And some of these we did see in the 2008 crisis. Where algo trading is dominant, there can be added risks due to potential failures of algorithms, IT systems, and processes. In foreign exchange markets, which is probably one of the oldest markets in the world, across the globe, while trade and direct investment flows are the primary movers for determining exchange rates, over the years, financial flows have overshot real flows in determining exchange rates. These financial flows are influenced by forecasts and expectations of behavior of macroeconomic variables, geo and national political factors, pure speculative behavior, and trading based on charts, algo, or otherwise. Central banks usually target interest rates and allow exchange rates to be market driven. And this is really the post Bretton Woods era. This happens for countries which have fully convertible currencies. On the other hand, some central banks, Argentina some time back, and others like Singapore even now, target exchange rates as the anchor for monetary policy rather than interest rates to maintain economic stability. And they have measures also to prevent the internationalization of their currency. So, for developing economies that need large capital investments, like such as ours, and usually operate with some amount of current account deficits, an appropriate exchange rate is one that ensures a sustainable balance of payments over the short to the medium term. Capital flows, especially financial flows, can provide comfort to handle current account deficits, but when capital flows reverse, and as they very often do, they can become hugely disruptive. So, prolonged overvaluation of exchange rates in relation to a country's competitiveness can also undermine economic growth and employment. So, exchange rates are very important for developing countries, and in most cases, they are not, while they may be to a large extent driven by market forces, market demand and supply, they're not completely determined by market forces, and some form of intervention, either by directly buying or selling in the market, or some form of capital account management measures through regulation, is practiced to different degrees in different jurisdictions. So this is where the role of capital controls comes in and the thoughts around capital account convertibility. Freeing capital controls may allow markets to become deeper with more participants, including speculators and arbitrageurs with contrarian views entering into the market, but this could also lead to prolonged overshooting of rates. And that may not be managed by mere exchange market intervention. For example, in the current financial year so far, foreign exchange reserves have increased by a record figure, more than $100 billion, more than in any year till date. This despite the fact that there are several restrictions on short-term capital inflows other than those that are trade-related. Obviously, this has put pressure on the Reserve Bank to intervene, and the build-up in reserves reflects this. The capacity of any central bank to intervene indefinitely is limited by its capacity to bear sterilization cost, and from the point of view of the economy, its capacity to improve productivity and retain its competitiveness. Hence, capital controls or capital account management measures, as it's now called, are very much a part of the toolkit of a central bank to manage its exchange rate and maintain financial stability. Capital controls are a rather strange animal, though. When there is a problem of plenty and inflows are tightened, and the policy response is to make outflows more liberal, the result is usually more inflows. When there is a problem of shortage of forex and inflows are liberalized and policies are tightened and policies tighten outflows, then they tend to trigger outflows. Hence, most countries have sought to control short-term financial flows and restricted external debt inflows to certain caps. So the gradual increase in these caps and the gradual liberalization of the conditions to which these external borrowings are pegged to is done in a way that is well calibrated, keeping in view the point of financial stability. And this again, Governor had mentioned. So the buildup of reserves is also to be seen as a buffer against the reversal of such capital flows. But the buildup has a cost, as you all know. It's equivalent to the interest earned on the foreign exchange reserves and those paid on the debt. Also, there is the very famous trilemma: managing exchange rates, open capital account, and independent monetary policy. So everyone agrees that we do need to develop and deepen our foreign exchange markets and debt markets in order that the markets get deeper. There is a very good interaction between the bond market, the currency market, and the derivatives market. And there are arguments that the curbs on foreign entities operating in the Indian financial markets, if these are removed, this will deepen the money and debt and forex markets and provide very efficient ways of hedging market risk. No doubt, the development of these markets will enable the more efficient allocation of financial assets, especially by allowing foreign entities to enter and help in the hedging and distribution of market risk. But what are these measures to promote? We have seen, or we have already seen that from the discussion that I already said on exchange rates, if this is done, then you allow more foreign entities to domestic markets without any calibration or unlimited. It will only result in loss of control over the exchange rate and over monetary policy, as interest rate differentials will quickly be arbitraged away. So one way in which we can develop the domestic markets is really for all of you members of the FEDAI, to get more residents and non-residents eligible to use the onshore markets for their hedging operations as opposed to operating in the offshore. And the task force that I headed last year had this as its central objective. Since the time the report was published, the triennial BIS survey of 2019 shows that between 2016 and 2019, the offshore market has trebled, while the onshore market was static. The daily turnover in the offshore NDF rose from $16.4 billion in 2016 to $58.4 billion in 2019, while it rose only by $1.6 billion from in the domestic markets, in the onshore markets, which include the forwards plus the swaps, from just around 16.3. So in 2016, when the domestic forwards and swaps market was ETF market, around 16.4 billion, in 2019, the onshore forward plus swaps market rose to only 17.9 as against 58.4 billion in the offshore markets. So bringing the markets onshore must be the mantra for FEDAI members. I understand that Reserve Bank has acted on almost all the recommendations of the task force to make it easier for non-residents to access domestic markets. The retail trading platform of the CCIL is a big step forward, and I think all forex dealers should use these platforms to market products to FPIs and other non-resident clients who do business in India. The suggestions made by the task force relating to custodial and settlement arrangements, and in all our interactions with the non-residents, with all the big companies who operate in India, with all the FPIs who operate in India, all of them said that they would rather have a single global custodian. And they actually felt, they were not even aware that the margins in the domestic forward markets were so narrow. The spreads were so small as compared to, say, the offshore markets. So I think there's a huge opportunity for our domestic players in the foreign exchange markets. And once these custodial arrangements have, and all the plumbing is, complete, I'm sure it will make it very much more attractive to non-residents to hedge their rupee exposures in the domestic market. The issue of production of an evidence of underlying, while the need for an underlying cannot be denied, one of the irritants is really the production of documentary evidence for the underlying. While the task force had recommended transactions up to 100 million could be allowed without such documentation, I understand that this is now kept only till 10 million. The idea of the task force was that trade monitoring through the LEI could allow directives to be applied by the regulator rather than have an upfront documentary evidence. I do hope this issue also gets sorted out, maybe gradually, and all players in financial markets will be monitored through the LEI requirement, which has now become a global standard. Indian banks have also been allowed to participate in the NDF offshore markets, which will give these banks understanding and exposure to the markets in offshore centers, and that will also enable them to lure these markets to the domestic markets. But this itself cannot be considered to be a precursor to capital account convertibility. If the markets in India have to develop further and deepen further, all participants exposed to interest rates and exchange market risk will need to use derivatives for hedging their risks. These will include banks, insurance companies, pension funds, mutual funds, and derivatives need market participants to promote and develop such products. The OIS, for example, is quite a good liquid market and has a large number of trades on a daily basis. But there are very few public banks in this market. The OIS benchmark of FIBIL is quite a robust based on active trades. The 3 and 6 month Treasury bill benchmark are also quite robust and offer a market opportunity to market participants to develop products and derivatives based on these benchmarks, whether in the OTC or on the exchanges. Again, it is up to the members of FEDAI, FIMDA, PDAI, AMFI, and all other market participants to contribute their bit to developing a very deep and liquid bond, currency, and derivatives market with all the regulators coming together for this purpose. I would also like to touch upon the IFC. All the regulators are coming together to evolve the regulatory system for the IFC. We need to use this as a laboratory or a proof of concept to see how it works without capital controls. The approach for regulation of this center perhaps should be not to look at exempting regulations applicable in the onshore markets, incremental basis, but rather mimic the offshore markets. Correctives then can be applied quickly because it is a small, limited sort of a laboratory that we are working. To sum up, further liberalization of capital controls in the onshore market at this stage are not warranted in order to develop deep and liquid forex, money, and debt markets. Market infrastructure, microstructure needs to be further worked on to provide for global custodial arrangements and other requirements of end users. And the platforms need to be made very user-friendly. And more importantly, the forex, money, and fixed income market dealers in India have to actively market these platforms. Limited experimentation with convertibility can perhaps be undertaken in the International Financial Center. So with these remarks, I conclude, and I'm really looking forward to the panel discussions. Thank you.
Thank you so much, ma'am, for those wonderful remarks. Definitely a lot of food for thought. And I think with that, everyone's ready for the panel discussion. Thank you once again for your presence today.
Thank you.
Ladies and gentlemen, food for thought, wasn't it? Like I said, it's going to compel you to put on that thinking cap. And I think now we're completely ready for a very interactive, very informative panel discussion. Like I told you just before the pre-panel comments, the topic is going to be market reforms leading to deeper domestic markets. Because to CSE. All right, ready? So with this, we're going to call our esteemed panelists. First up is going to be our moderator, Shri Arun Prasad, Head of Sales, South Asia Refinitiv. Let me tell you a little more about his body of work. As Head of Sales for Refinitiv in South Asia, Arun is responsible for business development in a dynamic market for the wide range of content and trading capabilities on the Refinitiv platform. Arun has over 20 years of broad management experience across algorithmic trading and market risk across equities, fixed income, and derivatives. We also have on our panel Shri Sravan Kumar, Head Marketing, Treasury Products and Technology Initiatives, ICICI Bank Limited. He has 17 years of experience, all in finance and treasury. He currently handles market making desk for FX and derivatives. We also have Shri Vaneet Gupta, Head of FX Trading, Standard Chartered Bank, and Shri Ashutosh Raina, Senior Vice President, Head Forex, HDFC Bank Limited. And with them, it's going to be a very, very interesting panel, which I shall leave you to. Can we please have the panelists on the beautiful virtual screen?
Thank you, and good to everyone. My name is Arun Prasad, and I think thank you for the wonderful introductions also to our host today. Before I jump into our panel and welcome all our panelists also, I wanted to thank Srimati Usha Thorat for building such a wonderful panel platform for our discussion today. I mean, it has given a depth of context, and I think it will really drive our conversation today. And thank you, Vaneet, Shravan, and Ashutosh for joining our panel today. So the topic today really touches on three interconnected elements in a market. First one being market reforms. It's been a wonderful year for market reforms, especially from RBI. A deeper and sophisticated domestic market, and lastly, how it's connected to capital account convertibility. So these are the three elements that our topic really wants to cover. Let me start actually going back to COVID-19, something that really impacted the markets, not just that globally. From liquidity perspective and managing volatility and avoiding distortions, I just wanted to get a sense from you as to how did the markets really perform. Vaneet, if you don't mind, could I start with your views on this first?
Sure. Am I audible?
Yep, all good.
Okay. So, I think COVID impacted the markets across the globe, and so does it impacted the Indian market. And while we have seen many events earlier as well, where there was a bout of volatility in the market, the unique thing this time was the lockdown along with the volatility. So there were multiple challenges. Wherein majority of the staff were forced to work from home. And I guess, like me, most of the traders across the globe never thought they could be in a work from home environment ever. So it was a unique setup for, I guess, every bank, every trader. So apart from managing the volatility in the market, which I think the local currency market behaved largely in line with the global market in terms of vol. We had 1% plus moves on many days, but that's largely reflective of how the market has been across the globe. Along with that, I think everyone had a unique experience of managing that along with their network issues, setting up desktops at home, working over VPNs, and managing the delays in terms of executions. But I would say a good takeaway from that is that we are now open to work from home, and we have done it for last 6-7 months. And that is something which I think COVID has taught us that that's also possible and feasible over a longer period of time. One unique thing which happened during the COVID period for India market is that RBI allowed the access to NDF markets, and that kicked in June. And I think that helped the local banks in terms of additional liquidity. And if I compare the volumes we were dealing post the initial bout of volatility versus the time of the market, which was reduced to 4 hours, I would say on an average the liquidity once the initial reaction was over was pretty okay. And if I couple it with the NDF market liquidity, I think it was fairly stable. And RBI did obviously manage the volatility on and off to stabilize the markets as and when they become overly volatile.
Thank you, Vaneet. Shravan, if I could get your views on how was the whole COVID-19 impact, and how was volatility managed by markets for the functioning of the markets?
Yeah, hi Arun. I think before we start in terms of what we did during COVID-19, it's interesting to note that from end of February to 24th March, which is when the lockdown was announced in India, dollar rupee moved from 72.25 to close to 76 on account of factors, probably global COVID factors, as well as other market movements that were there. I think post the lockdown announcement, if you take over a period of time, while we have seen lows of 72.80 and seen some highs of over 76, as Vaneet pointed out, broadly speaking, in line with the global markets only, our movements were there. The second thing we need to recognize is that because of the lockdown, not just in India, but globally, economic activity and trade was impacted. Obviously, this means that end users who also are part of the market and who make a big as such, that makes a significant difference to the way, how much volumes get traded, and that of course impacts the volatility. But as we progress beyond, the first initial months, and we began to see a lot more flows on the capital side, we found that the market was able to reasonably absorb the flows, and the volatility levels were fairly well contained. I mean, one measure of looking at it is in terms of implied volatilities. I look at the 6-month implied vol, for instance. When we started off in March, we were trading somewhere in the 8-figure range. We have comfortably come back to the close to 6-figure range, and which is broadly a very, very manageable range, so to say. So to that extent, when we look at it from an overall perspective, I think the volatility got managed well. There were, of course, some bouts of, liquidity gaps that were there, specifically when you have, say, some large flows that are there. But other than that, I don't think there was any. I think we should be reasonably happy and proud about the way our FX markets handled this entire period. We must realize that we are also a part of the, interconnected with the rest of the world, and when compared to the rest of the world, I would like to believe that we have performed rather well.
Thank you. So that's a wonderful word on the liquidity and our management of volatility in our markets. Ashutosh, would like to get your views also and perspectives on this. Do you concur with everything that's been said, or do you have any new insights from your angle?
Yeah, hi, good afternoon, Arun. I agree with both Maneet and Shravan. I think if we judge at the volatilities across the globe, I think India was the only market where the volatilities were the lowest among the even better than the developing markets. So even if we look at the 1-month volatility of euro, it was around more than 15%, whereas INR was only 14%. And if we go as far as to Latin American countries like Brazil, etc., it touched around 30%. And initially, when the lockdown was announced and COVID cases started to rise towards the end of the February and towards the March and April period, the rupee saw a bout of depreciation. There was immediate knee-jerk reaction. We moved from 72 to 77 levels. I think with the offshore onshore arbitrage moving to almost 1 rupee arbitrage in certain maturities. So I think after April or mid of April, things started to stabilize, and pretty sharply we saw that rupee also stabilized in a range, and we should also thank RBI and its team, who kept the liquidity question marks at bay, and the toughest times were handled much better by RBI. Post April, I think we have seen normalcy returning back. At least trade flows have resumed, which had significantly reduced during that initial phase of the lockdown. So I think we have a calmer INR markets now.
Fantastic. I mean, it seems like I think the markets are coming back. We've come back to a normal rhythm. It's important to note, even from an operational risk, how all of us together are operating in this environment. Work from home, we can actually, like Maneet, you mentioned, we can do it. Shravan, you mentioned about how the markets reacted in March and how we've come back to normal. Ashutosh, you mentioned about from a context perspective, we're really coming back. The volatility, us against the global market, we perform better. So that's a terrific vote of confidence. I just want to pick up a couple of things, if you don't mind, from your conversations. I think Maneet, you mentioned about NDFs. Volatility out there. I think Ashutosh, you mentioned about the onshore, offshore arbitrage. Let me start with you, Ashutosh, on this. When you look at the NDFs, it was, the launch of Indian banks being allowed to trade in NDFs was definitely, I would say, a seminal event from a market reforms perspective. Do you think we need more enablers like NDF, or just NDF itself? Does it need more enablers, or are we okay at this point from what we have?
So to respond to your questions, I'll simply start by saying that sometimes there are decades for which nothing happens, and there are times when events happen in weeks, and opening up of NDCs to Indian players was such an event. So this should definitely be a driving force for next business growth for Indian banks, particularly in the FX space, both in terms of volumes as well as profitability. Now, if we look at the volumes after the opening up of the NDF in Indian markets, on first, the volumes immediately touched more than $2 billion in the month of July itself, after which it has stabilized around those levels. So, what I feel that uh, we should target that these volumes have to increase manifold. Instead of having these at multiple centers across, we should have avenues to get these flows onshore. So for this, we need some enablers, which I think the biggest one being the use of ETPs. As of now, we don't have the access to electronic trading platforms for accessing the liquidity in the markets. That is why we don't have too many market makers at the moment in the markets. The liquidity is a question mark at the moment. Providing of pricing is a question mark. If we have some more foreign banks joining the IFSC space and having more providers, I think we can have a better NDF markets change of moving of volumes from offshore to onshore markets. Eventually, we should be looking to expand the horizon and market share for Indian players and local entities in the NDF markets.
Thank you, Ashutosh. Vaneet, I would like to get your views on NDF. You had mentioned it at the start itself. To share your insights on how NDF how really impacted your business, and where did you leave with it?
So Arun, what it has done is, as Usha ma'am mentioned in her speech before we started the panel discussion, the offshore market has grown by leaps and bounds in last 3-4 years, whereas onshore market has pretty much remained stagnant. It obviously was driven to some extent by the controls that regulatory controls we had in India, and hence the effort was made to liberalize India's controls more and more, so that we start getting some of those flows here, even if it is in the NDF format, and that's why probably the regulators came out with access to Indian players to the NDF market and the ability to offer that contracts to offshore players in their books. So I think for our business, it's a very good step forward. It gives us the opportunity to get those flows here, and along with other liberalization steps that RBI took. To my mind, this will increase the liquidity onshore tremendously going ahead. As Ashutosh mentioned previously, maybe I think other foreign banks will join the fray soon, and we will probably sometime next year get into a mode where NDFs are starting to quote locally through brokers, and some kit of market starts developing here. It's obviously a long process because it takes time for any new market to develop, and I think that'll happen soon, and it'll probably deepen the local market a bit more. I don't personally think the volumes in NDF will reduce, but locally the volumes will increase multifold, both in onshore as well as NDF markets traded locally. So it's a wonderful step forward. We are hoping, and we've represented to the regulator through FEDAI for some more enablers, so that the execution and the access to the market can be simplified and becomes easy. And I'm sure they'll be looking at it and giving a positive response to that, post which we are hoping we'll have the volumes increase multifold next year.
Thank you, Vaneet, and thank you for the vote of confidence on the whole NDF launch. Definitely, I think we all are looking for a positive outlook on this, with growing volumes. Shravan, I wanted to bring in your views on the NDF market. Where do you see it heading? What any areas which you would really point out from your end?
Okay, thanks, Arun. So I think first of all, I'd like to start off by saying that we were all very pleasantly surprised on March 27th when the announcement was made that Indian banks would get access to NDF markets. Having said that, and once we started off, and as Ashutosh pointed out, we have some data in terms of what the volumes are based on the RBI paper. I think for the volumes to grow ahead, and for maybe a lot more of, say, incentivizing people to deal with participants onshore, I think there are a few things that are there. One thing Ashutosh just touched upon is more in terms of access to electronic trading platforms. It is extremely critical, not just from a distribution perspective, but also from the perspective that in case you're a market maker, you would like to be able to price on multiple, venues, which is OTC, different exchanges, different NDF platforms, and that is pretty much the way a market maker operates. So to that extent, that becomes very. Second aspect that is there is NDF market. We can only deal with non-residents. Non-residents typically tend to deal, with credit arrangements such as CSAs in place. And well, at the time the market started off, there was no enabler for cross-border collateral. Recently, of course, we have seen the Gazette notification for cross-border collateral. We are hopeful that the final guidelines will come. Once you have that, you will have there's a case wherein the non-resident can directly deal with the participants in India, which is where most of the banks will be managing their risk, which will ensure that what it needs is, once latency goes away, and second thing is it's better aggregation of flows that will happen, and it will help traders price better. And obviously one of the things that will matter in terms of being able to get the offshore participant to come to our market, be it either NDF or the onshore market, is pricing. Because beyond a certain point, for a number of participants, especially on the speculative side, pricing is probably the most important one. And for that to happen, ETP as well as, I think, cross-border collateral would be extremely critical. We are just, as Vanith also pointed out, in terms of ETP representations being made, and cross-border collateral, we are hopeful will come out very, very soon. Once these two come, it should help us in a long way. The third thing that I might have added is probably in terms of product suite, but the April 7th guidelines have liberalized product suite to a very, very significant extent. And the only other thing that is there, of course, is the suitability appropriateness guideline, which is also expected to come out very soon. So what this means is that if you're an offshore participant who's dealing in the NDF market, let's say you don't have exposure, you still want to deal in the NDF market, your choice to deal is no longer restricted only to banks outside. You can deal with banks in India also, because all the issues that you might have taken into account in the past are pretty much being addressed.
Thank you, Shravan, and that's a great segue. I mean, a segue to the April 7 guideline which came out, and that I think was another one. It was, and like you mentioned, Ashutosh earlier, right? I mean, this year has been really groundbreaking in a way that for decades nothing happens, and then March we have a regulatory guideline coming out. April we have RBI Circular 29 coming out, changing the derivatives landscape. I just want to get your views. Let me start with you, Shravan, on this, continuing with your discussion. What product development initiatives is it triggering on within banks like yourself, especially around derivatives and exotic derivatives?
Okay, Arun, before I move to the exotic levels, I thought I'd just give a bit of background also in where this April 7 guidelines sits in the overall scheme. I think if you look at this year, in Jan we had two changes that happened. One is to make $Rupee 24 cross 5, and then of course allowing to begin with Gift City branches to deal in $Rupee futures contracts settled in Gift City. The third thing, of course, was NDF. The fourth one is the big reform, the April 7th reform. The only thing, of course, is that the April 7th reform is something we all knew was coming because this had come, its draft had come out last year. So a large extent, market participants had a sense of, what was coming. Of course, after this, we have seen the netting legislation getting passed, among other things. Typically, what has happened in terms of derivative markets in India is that, the issues that people tend to put out is that we can't trade 24 cross 5. Our ability to deal more products is very restricted. Our transaction costs are high because we put capital on a gross basis. Lot of these points that we might have put out have all got taken into account over this year in a series of reforms that have happened. So to that extent, we now have the enablers for developing a very, very vibrant derivative market. Having said that, when we look at new products, we need to be cognizant of a few factors. I think the first factor we need to be cognizant about is that the end users over the last 10 to 12 years have practically been dealing in fairly simple products, forward some kind of option structures. The same is true of the Indian banks also. So when it comes down to development, while over a period of time, a lot of us and clients also would have wanted to structure products in certain way, we have not been able to do so. But the experience of actually dealing in these products from a client side and in terms of managing the risks from the bank side is something that will evolve over a period of time. I think what the April 7th guideline does is that it gives tremendous amount of flexibility for banks and customers to come out with the products so that they can serve the needs of the customer, and banks are put in place necessary systems for their risk management. One thing we need to be very, very cognizant and cautious about is the fact that this exotic products, whatever you are referring to, are pretty much now permitted only for what the Reserve Bank has classified as non-retail clients, which is like customers who are more sophisticated. So any of the accidents that might have happened in the past, to some extent, are getting cut out at that end. Having said that, banks will put in place the necessary risk managements. We have the memories from that time to make sure that whatever products that we offer to our clients are appropriate to them and do not generate any additional risks. And the last thing is that when we look at exotic products, I think we should not just be looking at it in terms of, say, a knock-in, knock-out type of products. There are other products like cancelable swaps, cancelable options, Asian options, which are much more simpler probably in nature, and these are also products that could take off. So it finally comes down to the ability of banks to develop the risk management technique over a period of time, as well as customers to get used to it and modify their risk management policy so that they can take advantage of this.
Thank you, Shravan. And Vaneet, I wanted to get your view with the Standard Chartered Bank. If you look at the offshore markets, as a global bank, it has been dealing in their risk and also structured products for quite some time. I'd like to get your unique perspective from that angle on what this means, or what the April 7th guideline really means for you and your bank.
Sure, Arun. I think the biggest takeaway from that guideline, as Shravan also briefly touched upon, is the massive flexibility that this guideline gives to the banks to offer the product suite, and to the clients to switch very, very easily from one product to the other, because you can now cancel and rebook as many times as possible. So, while I don't see we getting into a lot of exotics to begin with immediately, it will obviously take some time for the clients to get educated and be sophisticated and reach that level. Apart from the few professional clients, I think what it does is it gives you the flexibility to, let's say, go and propose a structure to the guy who was, I assume, not looking to hedge earlier. But if you show him a structure which is a little bit more risky, but nonetheless better to do rather than not hedge at all, he may just bite. And overall, from the client's perspective, it gives them at least the optionality of hedging their risk at a lower cost rather than not hedging at all. So I think that's a tremendous thing. Secondly, this guideline gives a lot of flexibility to offshore clients to come and cancel and rebook at will, and move their hedges with let's say the same bank and the same counterparty from onshore to offshore, depending upon where the things are cheaper, be it the wall market, be it forward market, be it outright. That flexibility also will help in driving the agenda of getting more and more flows onshore. So I see a lot of simple hedging instruments in demand, simple callables and simple cost saving structures, which clients will be very much interested in. And I think it's a great step forward to start this market again. And now with the help of access to NDF, which where these kind of structures have always been dealing for last so many years, in spite of India market not dealing them. I think we can lean on that market. With the access to that market, we can lean on that market to start pricing structures, and that lag time, I think, will reduce significantly in terms of banks' capability to offer these products.
Yeah, got it.
Thank you, Vaneet. And it seems what you're pointing out to is that the NBF market, the derivative markets, they'll all get very much interconnected. The pricing will flow through, and the options will come for every investor. Ashish, I wanted to bring your view on this, and also get your sense of from a product suitability perspective. What is the onus on the banks, especially with these kind of derivative products? Do you have any thought on that?
I think with these of regulations, these reforms, the responsibility on banks increases manifold. I think I think we are moving towards principle-based regulations now, where the onus is mostly more on the bank than on the regulator. So banks have to be very, very careful while looking at the appropriateness and suitability of the clients for various products and what products to offer to which clients. So we can see we have $10 million up to free hedge without any underlying. You can have a $10 million of exposure. We have introduced anticipated exposures, and also banks need to have robust risk systems in place to anticipate the kind of products that they are going to offer to the clients, and which kind of products ought to be offered to which kind of clients depends on the risk profile of the client also. So whether the client is able to manage that risk, understand that risk, and ultimately trade that risk, so that onus shifts to the bank. So banks, the responsibility of banks has increased manifold now after these regulations have come into effect.
Thank you, Ashutosh. I think, Shravan, you had also mentioned earlier about how clients have to get educated, management practices within the banks also have to get it. In your view, when you talk to your customers, where do you think customers, especially what are supposed to be sophisticated customers, how are they getting ready to trade in the geography? Are they at the start of this journey, or are they taking active steps to prepare to enter into these kind of structured products, or even a little bit more sophisticated derivatives?
Arun, I think the answer to that is that it's across the spectrum. So it is very hard to give a single answer saying a yes or a no. I think it's across the spectrum. I think there are certain clients who definitely are very, very keen on this, and they would like to, take as much flexibility as they possibly can, and would be very, very keen to start off on dealing in these structures. There are other customers who may do it, once in a while and look at it in terms of, see how it goes and then decide. And of course, there's a third category who, in some sense, say that, we're happy with the doing, and then let's see, depending if there is an opportunity that is there at any point in time, it gets there. I think if you look at it from an end user perspective, I think finally at the end of the day, they look at it from a risk reward perspective and from a risk management perspective. We need to understand that for a number of clients, the main focus, of course, tends to be their business. FX hedging is a part of, managing their overall business, and they don't want to have undue risks that they want to add to, from the business perspective. So the is different at different clients. So my short answer to that is, it's spectrum. There are people who are ready.
Vaneet, do you have any views on product suitability and how ready are Indian customers to take on derivatives?
As I said, I think we will probably start with the simple structures rather than getting into really complicated exotic derivatives, and it'll be more of cost saving callables to reduce the cost that they'll go through, rather than getting into really knock-in knockouts or barriers. I think that's where the thing will land, and as the market progresses slowly and clients come up with their knowledge base increasing and systems getting more sophisticated, I think it'll be a slow journey, but nonetheless a step in the right direction and very much required, I think, at this point of time, if we need to develop this market further ahead.
Thank you, Vaneet, and for your thoughts also on this. It does look with I would say, a medium to long-term journey, and I think the market also has to evolve. I think customers, from what we're hearing, is that customers also have to get used to these kind of products, and it has to fit to their business needs, like what mentioned out. if you look at this year for market reforms, given the pace of the reforms that have happened, what's your view these reforms have played in inching towards capital account convertibility? Let me start with Ashok, your views on that.
Amit, I think the Indian approach to current account convertibility has been of a gradualism rather than a one-shot event. So, with the policy in approach to liberalization being cautious in a sequential manner and in response to domestic monetary and financial sector developments, as evolving and as also as evolving international financial structures. I will also say that it will be prudent to let the overall economic scenario develop towards that rather than especially pushing a specific objective. From the experience of other emerging markets, if we look at the Asian tigers and the Latin American things, we can see that current account convertibility should be more of an aftermath than a precursor to the economic development, economic growth. So for now, letting the market come to you seems the logical way ahead, rather than we chasing and trying to account convertibility as do reform soon as possible. So it should be more of a gradual process than a one shot or a very fast pace. I think RBI is doing the reforms in a very gradual and very sequential manner. And we have seen this year, a lot of reforms have already happened, which may be precursor to current account convertibility, but I think still we are way away from the full convertibility thing. It may take a long. We are still a lot of distance away from the full convertibility.
Vaneet, would you have any views on the role the reforms are helping us inching towards capital account convertibility?
Yeah, Arun, as the Mr. Shaktikanta Das in his speech also touched upon this topic of capital account convertibility, and he very much summed it up it as a gradual stepwise approach rather than doing it in one shot. However, I am very pleased with the way that gradual approach has accelerated this year in terms of giving out some of very significant reforms in FX market, which probably we were hoping, thinking might come earlier. So if I look at it in the past, I think over last 2-3 years, probably the reforms were slow to come by. And access to NDF market was definitely a pleasant shock that came in. But apart from that, I think the other reforms that have come in along with that of exotic derivatives, freely cancelable and rebooking, all are pointing to that direction. And we are, I think, moving maybe slowly, but definitely moving much faster than the earlier years in that direction. And happy to be there and be part of this journey of INR moving towards capital account convertibility with the slew of reforms that RBI has come out this year, and hopefully we'll be working with them to take this journey forward in the coming years as well. But I think significant steps have been taken this year, and hopefully next year we'll see the fruits of that in terms of flows getting onshore.
Thank you, Vaneet, for covering that. And one thing here is that really, I think it's people are realizing that they're moving towards step by step, a gradual but cautious approach. And it's interesting to see all these different reforms that have been put in place, how they're coming together to make the market more sophisticated. And Ashutosh, like you mentioned earlier about the whole point of principle-based, approach taken. All the right steps are being taken. A cautious but step-by-step framework is being put in place to ensure that our economy is also managed. Plus, we're liberalizing the markets. That's really great to see. I think we're coming towards the end of the panel, so I just got a pop up on my screen, which there was a question that came up, and actually there were two questions that came up, and let's go to the first one. And the first one was right. Let me start with you, Shravan, here on this one. Is in the coming year, what trends do you see shaping the FX interbank trading and FX distribution sales? Let me start with you, Shravan, on that one.
Sure. I think one thing that's inevitable is in terms of both for interbank and from the distribution side is to move towards more and more on technology platforms for prices to be quoted out on technology platforms and whatever are the associated things that come along with it. I think that is one trend that I think we will see. Second thing is that the April 7th guidelines, giving a lot of flexibility to foreign participants in terms of, all their issues being addressed, how much their volume comes here, and, how that affects the way the market microstructure is there in India. The third thing is in terms of our small clients, because we have made document very, very simple so that up to $10 million, the documentation has been significantly eased. A lot of whom may not have undertaken forwards because of the documentation issues. They will all, we have to wait and see in terms of how they look at it and how they overall risk manage. So these I think are three broad areas that we need to wait and we need to see. And of course, the fourth one is something that we have all discussed about fairly well in terms of impact of NDF and onshore and NDF and how that progresses.
Okay. Thank you, Shravan. Waneet, any views from your side as to what will shape the FX interbank trading and sales in 2021?
Yeah, Arun, with all the reforms coming in and the flows coming onshore more and more, and the liquidity increasing, I assume over next year or so, one trend which I think up is some bit of algo trading and machines taking over the trading, which we've not seen in India so far. It's largely been an emerging market with most of the things happening manually. There are few banks who have the machines manage the flows, but by and large, it has been traders sitting and doing most of the things. I think electronification of this market as liquidity deepens, the way G10 market has developed, probably will take few steps in that direction as well next year, apart from what Shravan mentioned earlier.
Thank you, Mohit. That's interesting. I think that was a good segue that you mentioned about the whole algo trading coming to India for FX markets. Ashutosh, I would love to get your views on, do you think, algo, for example, is that really something that will shift for 2021?
Yeah, we definitely see technology as being the next primary enabler in the same. Next year, I think already most of the banks are pricing over electronic platforms, but the platforms being run and driven by algos, I think that's the next big step that Indian markets can see in the foreseeable futures. And to add to that, I think 24/5, this round-the-clock markets in India, which I think after the COVID got a bit disturbed due to the COVID thing, once we have 24/5 markets coupled with the NDFs round the clock, and the need for these electronic trading platforms increases manifold. The pricing to clients and all that stuff. So I think the electronic trading platforms are going to take over the FX trading going ahead, and algos. I think algos and these HFT type are going to dominate going ahead, maybe 1 year, 2 year, or 3 year down the line. But definitely that is the path.
Well, I mean that's exciting. I think I think the whole market is also getting ready and actually embracing electronic execution, with open arms. Beginning to see that. We're really towards the end of the panel, but this is really exciting because this I think quite an interesting question that came up, and I'd really love to hear your thoughts on each of this. So the question is, and let me start with you, Ashutosh, is one area participants and regulators should come together and for 2021.
So I think we have had a lot of reforms this year, and now these need to be enabled and taken to the logical conclusion so that they bear the fruits of what they are intended for. So in this, I think for this NDF piece, we need that those netting legislations, all those guidelines to be issued immediately, which can help the this margin placement and all that thing. The second is the approvals for the ETFs and aggregator electronic trading platforms. I think we already have approached the regulator through FEDAI. So I think it is also in the pipeline. And I think once these enablers come, I think we should, as FEDAI and as market participants and all the regulatory bodies, should work with the regulator and RBI to ensure that these enablers are put in place so that we have much better and liquid and deep markets going forward next year, with the flows increasing manifold from offshore to the 24/5 markets, the remittances increasing anytime we can have remittances coming in outside the normal market hours. So that has to be the agenda going ahead.
Okay, thank you, Ashok. Let me try to summarize this. I mean, what you're saying is, I think the focus should really be on enablers for deep and liquid markets in India. Fantastic. I think that really sets the tone for 2021. How we, all of us market participants, regulators, banks, we should look forward to 2021. Vani, I would love to get your views. If you have to pick one area where market participants and regulators should come together and focus for 2021.
So I think Arun, we've as we've discussed extensively, there has been some major reforms which have been announced this year by RBI. Some of them are implemented, some of them are in progress of getting implemented, awaiting RBI's clarifications. I think probably 2021 will be the year to build on to those reforms, taking them to their logical conclusion and making sure that we implement them in the market and see the outcome, positive outcomes of that. Probably 2020 was the year to announce all these reforms, and some of the implementation got stuck because of COVID. I think next year, FEDAI and other market participants will be probably working towards taking them to the logical conclusion and seeing the fruits of that into the market, rather than getting any major thing done again in 21. I think we need to probably take these to their logical conclusion before we talk about the next step.
Okay. Thank you, Manish. I mean, let me try to paraphrase for this one. I think what I'm hearing is that you really want to just build on the success of all these policies and market reforms that were announced and take them to execution and embed it as capital market, the day-to-day function. Fantastic thought. Thank you, Manish. Shravan, I would love to get your thoughts on this particular question, which is, if you have to pick one area where the market participants and regulators should come together and focus for 2020.
Oh, I think there have been so many changes that have come out this year, which are, some of which have been implemented and some which are working out. I think we'll work in 2021 to make sure that we consolidate for all these changes and we all gain the necessary market experience that is there and build on it, because what we do in 2021 is what will, the way we shape the markets for the next few years to come. So we all need to take care that we take it in the right spirit and develop the necessary infrastructure in place so that effects are there for a much longer period of time, and we make full use of all the changes that have been literally introduced for us.
Okay. Thank you, Shagan. And that's a wonderful thought to basically consolidate all the success, make sure the market really builds all the infrastructure together so that we build a very robust market out here in India. And thank you very much for that thought. So we've come to the end of the panel, but I would like to thank, we've covered a lot of ground. We've covered fantastic topics today. We covered about ND, covered about, what an important development that has been for our market. And all of us are looking forward for a very bright 2021. Especially, I think it's loud and clear that we really are getting our arms together, holding arms, trying to get the offshore players back onto the onshore market. So with that, I'd like to thank all our panelists, Vaneet, Shravan, Ashutosh. Thank you very much for your thoughts and really great insights from you. I'd also like to thank our audience for their time today, and most of all, 4thFEDAI and the organizers for hosting such a fantastic event. With that, thank you very much.
Thank you.
Thank you.
Thank
Thank
you.
you, John.
Thank you from everyone here at FEDAI once again for that lovely, lovely panel discussion. I think it really was an eye-opener, a lot to reflect on that was, and a wonderful way to set the tone for the year to come. We've had a very interesting first half of the day so far. We've had panel discussions. We've had some of the finest personalities that we've looked up upon for so many years come up and address us. We've had felicitation. I think it's now time to summarize all our, events of the day. I'd like to call upon our Chief Executive of FEDAI, Mr. Ashwini Sindwani, on this beautiful virtual stage, please. Shri Ashwini Sindwani ji, Chief Executive, FEDAI. Good afternoon, sir. How have you enjoyed the show this far?
Good afternoon, Pooja. It has been really great. Thanks to you.
Thank you so much, sir. Over to you.
Thank you, Pooja. Good afternoon, everybody. As we come towards the final concluding session for this today's program, I think it's my duty to acknowledge and also convey a sincere thanks to all the people who had really contributed, be it our own friends, colleagues, the other industrial body association, regulatory bodies, etc., who really helped us, guided us to make this program really a great success today. And in that sequence, I would like to start with the first of all our regulators, the Reserve Bank of India, who not only for this particular event, otherwise also, as mentioned by our chief guest, Honorary Governor, that they both believe in that increased level of interaction, more frequent consultative approach, etc. And we have really been noticing that in the recent past. And for that, I would like to convey sincere thanks on my behalf personally, on behalf of all the industry members, our members of FEDAI and the industry bodies, to all the departments. Special mention to Foreign Exchange Department, Financial Management, Regulations Department, Financial Management, Operations Department, with whom we interact very frequently, and the departments like DOS, DOB, etc. Thanks for their support, and special thanks to Honorary Governor Shri Shaktikanta Das for sparing time today to join us, share with us, and also give us some insights into the thought process of what the regulators are thinking. And we take note of especially what he mentioned about the four pillars of the market, like liberalize and simplify, internationalize, protecting the interest of the users, the buy side of the user protection, and also ensuring resilience and safety of the market. These, I think, are the four important pillars for the growth, development, and smooth functioning of any market. And I think in FEDAI that we also take that as a responsibility to make sure that we are contributing towards the success of all these initiatives which have been taken up. Thank you very much, Shrikanta Das sir, for sparing time and addressing us. And we would really take forward whatever you had given us as suggestions, insights, and look to more such interesting interactive discussions and meetings with you, as you had mentioned. And next, I would also like to, on my personal behalf, as well as on behalf of all my colleagues, friends, and the members, convey my thanks to Shri Dinesh Kumar Khara, Chairman, State Bank of India, for joining us today and also giving us some insights of the global markets. And I like and sincerely wish for that the next IMF report title we should read, the end of COVID. We are all hoping and that's along with you for that thing to happen. Thank you very much for joining us today and sharing your thoughts on the forex markets and the financial markets in general, not only in the Indian market but the global markets as a whole also. And I would also like to make special mention and thanks to our other speakers, Mrs. Usha Thorat. As Pooja, you mentioned it very rightly, the someone who doesn't need any introduction in this market. And as we have all noticed, practically, and mentioned by the ma'am herself also, practically all the speakers had mentioned she has been contributing to this market in so many different aspects, be it as a regulator when she was working with RBI, then in setting up of CCIL, and now in setting up of PIBIL. I don't see anybody else who has got that varied experience, and it was reflected in her speech also. The entire range of the issues which she covered, especially highlighting the risk management aspects, the correlation between various segments of the market, how one good thing can lead to maybe some more not so events in the future. One has to be always careful and always watchful on which direction we are heading and what we are doing. Very much, ma'am, for your contribution and thoughts and views. You always welcome, and I can tell you that always we gain and benefit from such interactions. Thanks a lot. And thanks a lot to our past chairman, Mr. H.K. Jena, and thanks in his usual very humorous touch which he gave to the otherwise maybe not that lively discussions, or normally the professional meetings end up being a little bit formal and little bit staid, and Mr. Jena in his usual style he always ends up adding some humor and making the situation lighter. And I'm referring to the comments which he made about the FEDAI day being conducted in the daylight, not the usual evening. But sir, I must mention to you, we all are wishing and praying. Hopefully, the next event we'll have really in the evening, not in the day again, with plenty of liquidity, of course. We are all hoping for that. Thanks a lot, sir, for joining us for this. And you always have been a good guide and good leader in your role as FEDAI chairperson also. And now we hope to continue getting the same kind of support and guidance from you in the new role as well. And next, I would like to thank all our panelists. I was really amazed with the range of topic of discussions which we went all over, from the pace of liberalization, the responsibilities it puts on to the market makers, and the level of awareness, level of expertise, and how quickly the users can really catch up to the new development, the pace at which the products need to be introduced into the market, and also talking about the algo trading, etc. That was amazing. That was such a wide range of topics which came up for discussion and very well covered and very well explained. And thanks, Arun, for driving, moderating that discussion. Thanks a lot, Vinit, Shravan, and Ashutosh for sharing your thoughts and views. We always look forward to maybe more such interactions, more such deliberations and discussions going forward. And special mention I would like to make to our technology partners, Thomas Cook, which have made this virtual event such a wonderful experience for everybody. And thanks to the team led by Jay, who have been all working with us relentlessly since last few days, and especially very intense exchanges we have been having since the last 24 hours. And I know we weren't talking to your team till as late as 11:30, 12 o'clock in the night, but never I saw any sense of restlessness or anything. People were quite supportive. Thanks, Thomas Cook. Thanks, Jay, for you and your entire team. And thank you to our sponsors, Refinitiv, for joining us for this initiative. And before I wind up, I can't forget and miss out on to our host of the day today, Pooja, the such a lively and beautiful host we had today. Thanks, Pooja, for taking the entire discussion, driving the entire process in a very smooth, seamless manner. And before I wind up, I would like to convey our sincere regards and thanks to all our audience who have joined us. And I must tell you, would like to share with you at we had today presence attendance was far higher than when number went past around 750 plus people who are online logged on to us, besides the people who logged on to the RBI YouTube on that or the Twitter handle. So I think that was something great, and thanks very much for all the audience for being with us and having faith in us. And maybe in between, people had some temporarily some technical issues, etc. I apologize for that. Next time, hopefully, we'll be much better prepared and better equipped for that. So, thank you everyone for joining, and also thanks to Mr. Shastri for joining us at the start of the ceremony and gracing that lamp hosting ceremony. And thanks to our entire board of directors, the managing committee of FEDAI, all members of FEDAI for being with us, for guiding the FEDAI team in doing better work year after year. And we hope to continue with the trend in the coming years also. Before I hand up and say bye to you all, I would like to say just take care, stay safe, and hopefully we'll meet in the next year with a much bigger and better annual day event, and that too probably in the evening, in the more physical form, not in the virtual form. Thank you very much. Thanks and bye bye.
Thank you so much, Ashwini sir. I don't think there was any better way. You didn't miss out a single person. Thank you for the wonderful words you spoke about me. But it's now time to thank you, and I'm gonna, do the honors. And you've actually driven the show beautifully. Enough cannot be said about the way you have looked after every single detail backstage. You've been so hands-on. Like you spoke about Thomas Cook, of course, they've done a fantabulous job of putting all of this together. The show driven by Jay, but you were also on top of it into the wee hours of the night, even despite knowing that we have an early morning. So thank you so much for bringing us all together on this beautiful virtual platform. And there is a lot of excitement about the event that we're already speaking about next year, which will hopefully happen in the evening, and it'll be on a very big scale. And I do hope to meet all of you all in person someday, though this virtual meeting is also really going to go down, and I'm never going to forget it. Thank you once again, sir. On this note, I'm your host, Pooja Kamal, signing off this beautiful virtual meet. As we know, we have totally rocked 2020 despite all the challenges that it threw on us. But now we know that we can and we will. With our systems in place, with our technology in place, and with all the wonderful inputs from some of the market leaders that have come up today and addressed us, we know that we are ready for 2021. We may not meet again, so I'm wishing you all a very happy new year in advance. And remember, we are absolutely unstoppable. I'm looking forward to seeing a wonderful journey for FEDAI up ahead. And thank you all for being so participative and so patient through this wonderful day. I'm Pooja Kamal, signing off. Thank you.